Hello and welcome to Davos Direct right here on ET Now. We continue to cover the World Economic Forum and much more than market expectations. Super Mario Draghi has actually gone ahead and announced a $60 billion bond buyback program every month beginning March 2015 to, of course, September of the next year, which is 2016. This is a huge shot in the arm, not just for Europe, which is seeing deflation at the periphery, but also emerging markets at large. Indian markets perhaps couldn't have asked for more, but what are the repercussions of this move, this unconventional monetary policy tool? How will this be put to use? Will the fractious polity once again play party pooper? Can ECB stimulus really revive the Eurozone economy? We did get a word in from Gita Gopinath of Harvard.
Everybody's been waiting for this for like a year now, and it certainly feels a little late. But that said, I guess it's better late than never, and I think that's the state we are in right now. The size of the purchases are big. It's about 60 billion euros a month, and that's kind of, that's a substantial size. I think we have to look at it from the perspective of the fact that the ECB for the first time is now able to go out and buy, government bonds in this systematic way, and that's a win. To your question of whether that's enough to revive the Eurozone, I mean, I think that's far from not enough. It's a piece, something has to be done, and I'm glad that they're doing it, but there are many other issues that need to be fixed.
Before I talk about the many other issues, besides inflation, and that's something that ECB has spoken about, what are the other objectives you think they could have had in mind when they announced this?
Right, so politically, the way they could sell it was, that they were trying to target inflation. Inflation numbers were too low relative to their target, and that's the reason they were doing this. But from my perspective, and of course nobody's come out and said this, I think one positive outcome of this ability to go out and buy these bonds is that if there is a next panic on the bond markets in the Eurozone, the ECB will be in a position. They already are allowed to buy 60 billion euros worth of these debt instruments, and they can go out and do that. And why might that happen? That might happen because of what's happening in Greece. You see, with Syriza possibly coming to power very soon.
That's right.
The big concerns about the Greek exit, what will that imply then for Spain and Portugal? Will there be a run on debt of these countries? And so having the ECB in a position to go out and buy some of this debt, I think, is a good way to prevent a run on the debt of these countries.
If I can just pose a counter question to you, there has obviously been very fractious polity all across Europe, and which is why the counter argument to this is that this is going to help, yes, momentarily, markets will rally this, economists are going to give this a thumbs up for the short term, but in the long term, the fractious polity and the lack of will really, I mean, Germany wasn't really on board as far as all of this is concerned, is going to perhaps spoil the party. Would you agree with me?
Well, there is a huge concern. I think we are still far from seeing, where all of this is eventually going to end up. I mean, is there going to be a stable Eurozone? I mean, this is one piece of it. The fact that they have the mandate to do this is a good thing, but at the same time, the fact that there's not complete risk sharing, the fact that if there are losses, some of this has to be borne by the national central banks, so that's kind of tears at the heart of having a common monetary union. So you're absolutely right that at this point one cannot sit back and say, oh, well, now we're on path to what looks like a stable Eurozone. I mean, that's far from that.
With real interest rates still being very low, what else can the ECB do? What kind of an elbow room does Mario Draghi still have? What tools or ammunitions does he still have at his table?
I think he's used all the arrows in his quiver. I mean, the interest rates are negative, the fundamental rates are negative. You have the rates at which they're willing to make these loans to banks at an extremely low rate. He cut it further.
That's right.
And now he has the quantitative easing. I think, he's done what he can do.
Let's shift focus away from Mario Draghi and ECB onto the shining spot in the world economy, and that, of course, is the United States. Now, Larry Summers, the former U.S. Treasury Secretary, had once called Raghuram Rajan a Luddite economist. He had to eat up his words very soon after that. But as far as U.S. is concerned, Larry Summers asserts that growth will peter down in the course of this year. Stagflation and deflation are the two trends that worry him about Europe, but unconventional monetary policy get a huge thumbs up from the former Treasury Secretary, who believes these are tools that will be used to revive economic growth.
I think the U.S. economy has achieved a kind of escape velocity. My guess is, though, that growth will be somewhat slower over the next year than it has been over the last several months.
What do you expect Janet Yellen to do with interest rate hikes? Because we come from India and a lot of what she does impacts emerging markets like ourselves. Do you expect her to hike interest rates sooner than expected, or will it happen sometime later this year?
We'll have to see. She said it will depend on the data. I hope the main data that will drive the decision will be data on inflation, not data on real activity. The Phillips curve is a sufficiently uncertain relationship that we should not raise interest rates until we see the whites of the eyes of inflation.
In the present world today, what are the pockets of turbulence that concern you?
I'm very concerned about the risks of stagnation and deflation in Europe, secular stagnation in the industrial world, and chronic deflationary forces seem to me to be an important economic threat.
There is a lot of reliance on unconventional monetary policy around the world, be it Europe, Japan, or even China to begin with. Is that something that impresses you, or do you believe this is being done in vain because growth has been anemic even for economies where this has been done?
I welcome the unconventional monetary policies as something that is constructive, but I think we're getting to the end of the era when central bank improvisation can be the world's principal growth strategy.
There was a time when the world feared peak oil, and now the world is very wary of cheap oil. Nobody saw this crude crash coming, but it has, and which is why we got Fatih Birol of the International Energy Agency to give a sense of, is this the new normal? When do prices really firm up? What happens to the billions of dollars of investments that have been tied up to the energy sector? To answer all of that and a lot more, we've got Fatih Birol of the International Energy Agency right here on Davos Direct.
The lower economic growth, therefore lower demand, plus a lot of production happening from US, Canada and the others. As a result of that, the price collapsed. And now I believe this is not a situation which will last forever.
That's right.
It's a temporary situation, and I expect that this demand-supply forces will find a balance towards the end of this year, and we may well see an upward pressure on the prices sometime this year. Many companies, oil companies, are cutting investments.
That's right.
We expect 2015 oil investments will be 15% less than the year before, 2014. It's a big drop.
That's
it
right.
only happened once in the last 2 decades when we hit the 2009, the financial crisis. So it is the second time it is happening. So it is a unique issue.
That's
so
right.
therefore, we will see a downward pressure on the production. And this will be mainly on the high-cost areas, North America, Brazil, and others. China's slowdown is a serious issue, but we shouldn't forget that China will still grow above 7%. It's a huge growth. But I also expect demand growth coming from the United States as well. For Russia, it is rather serious, I would say, because today 70% of the Russian export revenues come from oil and gas. And we expect with these prices, Russian oil and gas export revenues will go down by $150 billion. It's a big thing.
Yes.
And this would mean that a Russian economy will suffer, plus the sanctions that the international community pose on Russia means that the Russian production will be also negatively affected.
When you say upward pressure on prices, do you expect crude to be around $60 a barrel? Is that a new normal for the world, and should the world make its peace with that price by the end of this year maybe?
By law, I cannot give you a number,
Right.
but what I can tell you is that the current prices will need to go up in order to increase the production and find a balance in the markets. But I don't think that it will come to the levels immediately, to the levels that we have seen before this collapse. So $110, $120, it will not come there, but it will be an upward pressure. But in the meantime, countries like India, like other oil-importing countries, should make use out of this breathing zone, comfort zone.
The question that comes to all our minds is that how will India leverage this? Our stock, we don't trade in oil futures. It's not such an evolved market. And the other thing is storage. Storage is dismally poor as far as India is concerned.
I think one of the most important instruments, not fully, but mostly used by the Modi government.
That's right.
Which is to deregulate the diesel prices. This will, on one hand, lower the demand growth, which is a good news. On the other hand, it is good for the fiscal balances of the country. This is number one. Number two, I think India should make use of this time to improve the efficiency of energy use in the country.
On that note, we take a quick breather, but we come back with a double treat of sorts. We get you India's two most powerful bankers. Call it women power if you may. We get you Arundhati Bhattacharya of SBI and of course Chanda, Kochhar of ICICI Bank in conversation with ET Now. Welcome back. You're watching Davos Direct with me, Supriya, Shrinate, right here on ET Now. Time to get you the yes banker Chanda, Kochhar herself. While markets have been rallying in expectations of the next 90 days full of big-ticket reforms, she is far more realistic in her trademark pragmatism. She did tell me earlier today that the budget has a lot of euphoria around it because people have seen reform measures happen by this government. But she insists that it's going to take a while before these reform measures begin to show its impact on the ground. Another 2 to 3 quarters before investments really take off. Let's get you a slice of the conversation with ace banker Chanda, Kochhar.
I think the efforts and the direction is clearly backing this, and I would think the markets are therefore pricing in what they are expecting as results out of the current action and direction.
Do you believe the biggest challenge of the government right now is to temper some of these expectations? Because everybody seems in the market to believe that the next 90 days is where we will see big reforms. It's all going to be packed with big action. Do you believe the expectation needs to be lowered a little?
Well, I think what we all need to focus on currently is to actually get results out of the action. I would say that, and I think then the expectations would kind of move accordingly. It's always impossible to expect things in 90 days, and you're right in that sense. But at the same time, we must recognize that some of the steps have already been taken. I mean, a lot of those FDI allowances that have been made, the smaller approvals have started to come. I think a lot of clarity around at least the coal ordinance and so on and so forth. So I'm hopeful that all these actions will translate into results. But yes, nothing happens in 90 days and we should not expect magic.
The RBI has started to cut rates, 25 basis points. The day the rate cut happened, you were luckily at North Block and we all caught you there. You said this is the beginning of a lower rate cut cycle. How much do you expect rates to go down in this calendar year? And do you believe this is going to spur investment and also boost demand?
I clearly believe this is just the beginning and the signal. So now how much they would go down more in this fiscal year, I would think probably close to 75 basis points or so. But, a lot depends on how inflation moves. The bank's lending rates don't only depend on rate cuts. I think rate cut is just one signal. Their lending rates depend on their cost of funds. And we must remember that the cost of deposits are also somewhere or the other linked to inflation because customers look for real interest rates. But I think in the last few months, you've seen some reduction in the rate of deposits as well. So I would think a cut in the lending rates would also happen soon.
I'm just trying to get a sense of which are the sectors that banks will be looking as far as the credit offtake is concerned.
See, credit offtake is also going to move in 3 phases. The first is the retail consumer confidence coming back and they starting to buy vehicles and cars and homes and so on. We are already seeing that. The second phase would be increase in working capital. In a way, we are seeing a little bit of beginning of that because as demand increases, people will get more confidence to produce more. But the third and the big kicker will come only when investments come back. I think those are a few quarters away because it's not just about announcing policy reforms. It's also about, the existing stalled projects getting solved. And I think a big relief on that would come when the coal issue gets resolved by end of March and so on. So I think we have to give it a couple of more quarters before people actually start feeling that they can deleverage and start putting in money in new projects.
All right, from one powerful banker on to the very other, and both have been on the Forbes list of powerful women in Indian business. I'm talking about Arundhati Bhattacharya, who heads SBI. Excess of anything is wrong, and which is why she's cautioning against too much hope as far as this budget is concerned. But Ms. Bhattacharya does say that credit offtake will happen in sectors like roads, transport and infrastructure, and that will see the big turnaround. Her bet for this year, as far as rate cut is concerned, is between 75 to 100 basis points.
Anything in excess is something that one should avoid. But having said that, I think this government is showing a lot of resolve. The best thing I like about them is that they are listening and they're allowing you to talk. It is, of course, necessary for us to dampen over-enthusiasm. However, that does not mean that we should dampen optimism. Mainly because I think a few other macroeconomic features have also played in. One being the low energy prices. That is something that's very much in India's favor. Of course, it's experts' call as to how long this kind of a pricing will persist. But while it is there, I think, it's been a relief for us. It should mean better management of our current account deficits. And to that extent, it's definitely a positive for us.
The other part of comfort, and that's, of course, Raghuram Rajan's decision to lower rates. He's begun perhaps the turn in the interest rate cycle here in India. The question that comes to my mind is that when will bankers like yourselves decide to lower lending rates, decide to lower deposit rates? Because that is when the consumer will actually see the entire impact of what Raghuram Rajan has really done.
I agree with you. We have started lowering deposit rates about 3 months back. The rest of the industry is slowly catching up, and we will see that happen. And as that happens, the borrowing rates also will fall. It is going to happen, and I think the Reserve Bank is also quite sure now that the disinflationary trends are quite entrenched. So that does indicate a loosening or an easing cycle. And therefore, I think the rates will come down.
How much do you expect interest rates to go down by in this calendar year?
Very difficult to say. I think generally people are talking about 75 to 100 basis points. I would tend to be on the 75 basis point side. Let's see. Let's see how it works.
Which are the sectors do you believe which will lead the credit offtake, and by when will you see credit actually pick up?
Actually, credit offtake at this point of time is an issue, mainly because new projects are not there. Which are the areas where projects will come? I think this time it won't be so much power, but it will be in the renewable power space. It will be in urban infrastructure, roads, ports. I think these would be the areas where probably, you will see investments coming in. Also in respect of mining. Mining is another thing, mining and construction. I think these are the two areas where you will see a lot of action.
Time for a quick breather on that note here on Davos Direct. We come back with a conversation that Arun Jaitley had as an insight with the World Economic Forum here. I also come back and get you an exclusive conversation with one of the people scripting that union budget, Arvind Subramanian, who doesn't seem to be a big fan of ratings agencies. And of course, I get you a conversation. We put the government and the industry on the map as far as Make in India is concerned. Amitabh Kant versus Sunil Munjal. Welcome back. You're watching Davos Direct right here on ET Now. Time to get you India's Finance Minister Arun Jaitley, who has the unenviable task of reviving the Indian economy. And of course, he's scripting the government's first full-year union budget. The question that we did put forward to him is whether the truckloads of expectations that are riding against him are his bigger challenges, and should he actually temper them down. Not one to be bogged down by those challenges, Arun Jaitley is confident of meeting all of those.
We are going to keep the pace, and I have always said the budget is just one day, but it's an important opportunity for the government to outline its intention and its policy. But then there are 364 other days. And as the last 7-8 months have demonstrated, we've done much more even after the budget. We are maintaining the old tradition of the last day of February. It just happens to be a weekend. So it's for the markets to decide. Today, except for the US, the other economies are facing serious challenges. And therefore, if we can afford to reform and we can demonstrate that we are a very important destination, which is not only reforming, but which is also growing at a much faster pace. We need the investment. We need it in manufacturing, we need it in infrastructure, we need it. Investment is globally available. And compared to our domestic investment, it's cheaper investment which is available. And therefore, if we have the ability to attract it, I think we can on the ground see results.
Let's get to the other architect of the union budget, Chief Economic Advisor Arvind Subramanian himself, who very pragmatically insists that there is no need to lose so much sleep over fiscal deficit targets. The need of the hour really is to push public sector investment, which many experts believe will amount to some fiscal slippage. On his part, Subramanian also asserts that the new global context where crude oil prices have crashed have presented to the government some elbow room as far as the budget mathematics is concerned, besides, of course, putting some money into pockets of consumers like you and me.
We don't create the expectations, so we can't moderate them as well. It's something that's a creation of the external environment, and I think that it's something that the government has to live with, contend with, and it has to deal with that.
Many people that we've been speaking to believe that the union government is unnecessarily losing a sleep over meeting the fiscal deficit target to the last decimal point. Why not allow public sector investment to boost so that it revives growth, even if it amounts to a few fiscal slippage points here and there? Is that something that finds favors in North Bloc as we speak?
Given the state of our Indian private sector and the corporate sector, to durably raise growth, you need to raise investment. And so this time around, the public sector may have to, take a bit of a lead in the process. We also need to do all the things, to get private investment up. But in the interim, we may need to. So the fact that we need more public investment, I think,
it's no longer a secret.
Yeah, it's generally accepted, and the FM and the Prime Minister have been saying it everywhere. I mean, the question is that how do we reconcile that with our, medium-term fiscal framework? And that's something that we're going to discuss in the months ahead, leading up to the budget.
The last 1 month has actually seen the fiscal landscape change as far as the world economy is concerned, much to India's advantage. Crude oil has crashed, commodity prices have softened. How does that really impact your own fiscal exercise? What kind of an elbow room does that give you in budget making?
Well, it does give us a lot of room in budget making in two senses, right? One is that we've been able to deregulate diesel and eliminate the diesel subsidy. World prices have come down about 45 to 50%. We've shared some of that with the consumer, but the rest we've also the government has taken advantage to increase government savings as a result. So we've been helped in both ways, in reducing subsidies, but also in getting some more resources and savings by way of the excise taxes we've imposed on diesel and petrol. So it's helped both ways.
The government is making a huge sales pitch as far as Make in India is concerned. But how easy is it to do business in India? Have things really changed on the ground? And which is why we decided not to get one view or the other, but to put the two views together. We got Amitabh Kant, the one making that sales pitch, and Sunil Munjal, who's going to put in the big bucks as far as Make in India is concerned, right here on ET Now. Let's get you a slice of that very interesting exchange.
Well, there's a huge amount of interest. There's a huge amount of enthusiasm, and to my mind there's a massive amount of dynamism as far as India is concerned. We just have to take this forward and get this converted into actual investments on ground.
But from the people who actually put in the big buck in manufacturing, what are the challenges that continue to remain? I'm sure you hear from your peers who you meet here in Davos.
So challenges in India continue to be some of the ones we have faced for a while. Because while the government has started to address them, the actual action on the ground is only partially complete. We are all actively looking at what all will get implemented, whether it's in the area of taxation, whether it's in the area of labor reforms, whether it's a whole host of issues that needed to be addressed. At the same time, building physical infrastructure and reducing the overall red tape, both from the center as also the states, is actually going to be the magic formula which will truly help us make in India.
Most economies in the world who've pushed manufacturing to a great extent have actually given huge tax breaks. Does Indian government have the elbow room to do so?
Well, I'm not particularly in favor of giving huge tax breaks. My view is that India needs to get its infrastructure right. India needs a whole lot of measures to put the legacy issues right. One of the key issues on which the Prime Minister himself has focused very strongly is about creating the will to do good, ease of doing business. He said, in fact, he wants to make India the easiest place to do business. And I think this will have to be a continuous process.
Party pooper here is that it all boils down to the state governments at the end of the day. They're trying to get them on board, which is a very good signal as well. You know, a new federal structure that we're seeing in India. But is that the last mile connectivity? That's a big trouble, not just for domestic, but even foreign investors.
I have to say this is the single biggest thing that the government is addressing as far as industry is concerned, ease of doing business. Right. We've said, frankly, we don't want a lot. We only want three things. Make it easy to start a business, make it easy to run a business, and make it easy, if you have to be able to shut down a business effectively, efficiently, with the least amount of pain and the least amount of cost.
That's it then on this edition of Davos Direct. We will continue to get you more news, views, and plenty of analysis right here from this beautiful ski resort of Davos, where the World Economic Forum is indeed happening, where temperatures are steadily falling, but arguments are soaring rather high. It's been a pleasure bringing this show to you. We'll catch you tomorrow night.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.